Hi everyone, this is Pattu from FreeFinCal, and in this video let's talk about market timing and how to do it right. So this will be the first in a series of videos on market timing, and in the first video I'd like to establish the ground rules about doing it right. So let's start with the very basic. What is market timing? So market timing is a very crude term for what is actually tactical asset allocation. So let us say you start investing with 60% of your money in equity and 40% in fixed income, let's say in a debt mutual fund, and the 60% is in stocks or in a equity mutual fund, and you keep investing, and then you see that the market has moved up significantly. Then you're worried that you have 60% of your money in equity, and so then you actually book some profit from equity and shift it to debt. So let's say your asset allocation now changes from 60% equity to 20% equity and the rest in debt, and so you wait for the market to correct, and then it falls, and then when you think that the market is going to move up again, then you shift back to equity and make it back to 60% equity. So that is known as tactical asset allocation, or otherwise crudely known as timing the market. What is the purpose of timing the market? Now many people understand this wrong. They think that timing the market will give them more returns. This is completely wrong, and it has been shown by backtesting that timing the market has got only one purpose: to reduce the risk in your portfolio. It need not give you more returns. Sometimes it can give you more returns, sometimes it need not give you more returns. It doesn't matter. I mean, you cannot beforehand predict when it will give you more returns, but it will always reduce risk, and that's a guarantee. Now, is it possible to time the market? Now, if you ask any mutual fund advisor or even most financial advisors, they will say it is not possible to time the market. What they are trying to actually say is that, well, when it comes to mutual fund distributors, they're actually saying, if you time the market, I will lose commissions in my funds, in the regular funds. So that is the reason why they keep saying it's not possible to time the market. There's a huge conflict of interest involved. It's completely wrong. We can time the market. There's no problem about it. But it has to be done right. Of course, not everybody can do it. There are behavioral issues. It has to be done systematically, what method to use, and so on. That's what we will be talking about in this video and the rest. There's another question which you should be asking. It is possible to time the market, yes, but should you time the market? If you ask me should you time the market, my answer will be no. There is absolutely no need for you to time the market. For example, consider a goal which is 15 years away, and let's say you are investing for that goal 60% in equity and 40% in debt or fixed income. The usual advice that you will hear is, for example, if you're investing for 15 years and in the 13th year or 12th year start decreasing the equity allocation, and then that will reduce risk. No, it will not reduce risk, and that's very dangerous to do that. What you should be doing is that you should have a stepwise reduction to equity approach. So you start with 60% equity for the first 4 years, drop it down to 40% for the next 5-6 years or so, then drop it down to 20%, then drop it down to 10%, and then 0. See, you need the money only in the 15th year. This starts from 0, so 14 is actually the 15th year. So you need the money only in the 15th year, but look at that. If you start I would recommend decreasing this in the 5th, 6th year itself. And if you do that, I have shown in a post, you can see the link right there, that whatever returns that the market throws at you, good returns, bad returns, you will always be able to achieve your target corpus. So you should have a stepwise reduction, and if you do that, then there is no need for you to time the market. You can systematically invest and then systematically manage risk like this. However, if you, in spite of this, if you still wish to time the market, then you should know how to do it right. But many people get it wrong. They think that timing the market means buying on dips. That is, they'll just keep investing. They'll see suddenly the market fall down by 10%, then they want to invest more. Or they'll keep waiting. They'll wait for the market to fall down by 20%, 10% or 20%, and then they'll buy more. That kind of buying on dips, backtesting has shown that does not help in either reducing risk or enhancing return. The reason for that is, let's say you're investing 1000 rupees a month, starting from no, this month you start investing 1000 rupees a month via an SIP. Let's say after about 5 years, because of market growth and your investment value, you have a total of about 1 lakh. Now, what is more important, reducing the risk in that 1 lakh or finding out when you should invest the next installment of 1000 rupees? See, people who want to buy on dips are worried about when to invest next, but there is 1 lakh sitting in the market that if there is a crash, that will fall and you will have a huge loss, right? So buying on dips is not the method to time the market. If you want to time the market, you should practice tactical asset allocation. That is, out of that 1 lakh, you should book some profit and move it to debt safely, and when you think it's right to re-enter, you should move it back. Now the problem is that is how market timing will work. But the problem is most people do not know when to exit and when to enter. And the usual complaint is that there's nobody can find the peak and nobody can find the bottom. There's no need for you to find the peak and the bottom to do tactical asset allocation. It's complete nonsense. There are multiple market timing or tactical asset allocation methods available. You can use the index P, you can use 200-day moving averages, 10-month moving averages. You can use a combination of price to earnings, price to book value, dividend yield, also known as the Motilal-Oswal value index or the MOVI. You can use double moving average crossovers. You can use something known as Bollinger Bands, and there are many other methods. Many of these methods I have back tested and published results. You can see the link right there. So I will give you a brief overview of what this is, and my job from now on in the next videos is to explain each of them in a separate video. The most common market timing method is to look at the index PE. So this is the Nifty 50 PE, that's the blue line right there. And what you see in the center is the 10-year moving average. That is, every data point gives you an average of the 10-year, the past 10 years, the trailing 10 years. That's a 10-year moving average. This is the first standard deviation of that, and on either side, and this is the second standard deviation on either side. So one market timing method can be when the Nifty PE value hits the second standard deviation line of the 10-year moving average, you book profit, move to debt, and when it falls down to about to the 10-year average or around that area, you move back into equity. Again it moves up and moves up, you wait. First band you don't do anything, but when it goes into the second band, you book profit and wait, and then when it falls down, you move back in. But the problem with this approach is that you may have to be away from equity for like 12 months, 14 months, 16 months and so on. So that's a big problem. So you have to be hugely disciplined. People say systematic investment gives you discipline. Systematic investment does not give you any kind of discipline. Only market timing requires actual discipline. So that's the problem. The other method is to use the 10-month moving average. So you look at the price of the last 10 months and average it. So the red line is actually the index. The 10-month moving average is shown in black. So it kind of smoothens out this data. So when the price moves above the 10-month moving average, you invest in equity. You sell your fixed income and push it into equity. And when the price moves below the moving average, you book profit from equity and move it to debt. So that's the kind of timing that you can do. All these timings have worked. You can see have worked wonderfully in the past. You can see the links for this in the description box. Then there's a combination of the price to earnings, price to book value, and dividend yield. I'm purposely not explaining these concepts because I want to give you an overview. Otherwise, the video will become too long. But I'll make a separate video for each of these timing methods, and we will discuss that in detail. So Motilal-Oswal has a value index, MOVI index, which is based on all the three indicators, and the black line is actually the Nifty, the blue line is the MOVI index, the red line is the 90-day moving average of the index. So you can, that's slightly less noisier, and you can see that when the MOVI index is above a certain value, so for example, when the MOVI index is above 110 in this region, then your portfolio should have no equity because you think the market is overheated. and then the MOVI index falls below 90 or so, then you can have 100% equity and so on. So you can, in between, you can have a gradation and so on. So there are many ways to time the market. All of them are more or less equally successful, but very important to recognize that when you time the market, you may have to stay away from equity for months and months, like 12 months, 16 months, 20 months and so on. You should not worry about what this guy is saying on Twitter, what that guy is saying on Twitter, what is the opinion of the market, what market outlook. No, no opinions, no speculation, nothing. You look at technical indicators and stick to it. Then you can use two moving averages, a 365 day or 364 day moving average and a 150 day moving average. So whenever the 150 day moving average falls below the 365 day moving average, you sell equity and move to debt. And whenever the 150 day moving average crosses above the 364 day moving average, then you move back into equity and so on. But there are some problems in these technical indicators. One problem is called the whipsaw. That is, the buy and sell indicators can come rapidly. That is, the first week of the month it can be a buy indicator, 2 weeks later it can be a sell, another 2 weeks later it can be a buy and so on. So you cannot keep buying and selling back and forth. So you should choose an indicator where the buy and sell signals are kind of spaced apart every 6 months or every 12 months and so on. But there are many ways to do it. I will explain that in detail. Then there's another method called the Bollinger Bands. The Bollinger Bands essentially means that you have a 200-day daily moving average, which is the center line here, and then you have this is the standard deviation lines. The first standard deviation or the second standard deviation usually is used of this central line. So those are the three lines shown there. So you can, whenever the the price moves above the top band, then it means that the market is overheated. You have to book profit from equity. And it falls down to below the or when it touches the bottom line, then you can move back into equity and so on. So there are multiple methods like this. We will talk about that in detail. So overall, if you want to know how to time the market, first of all, ignore all noise, opinions, speculation about the markets. Use only hard data. Either you use long-term technical indicators. I have a post on this, but I will update it. I think probably tomorrow or day after. How you can use long-term technical indicators, and you can use macroeconomic indicators like inflation, for example, interest rate movements, or there are other macroeconomic indicators like fiscal deficit, the price of oil, the exchange rate, and so on. There are many other indicators that you can use to time the market. You must backtest and find out which will work, which will not, how often you need to buy and sell, and you need to adjust the frequency of monitoring. That is, how often will you time? That is, will you look at the market indicator every quarter or every month? So to minimize the buy and sell processes and so on. Then you must also understand that timing the market is for reducing risk and not for enhancing returns. Enhancing returns, if you get any extra returns, it's only a free gift, and it's not essentially the job, essentially the main aim of market timing. So you will have to shut yourself out from other information sources and execute it in a completely systematic and disciplined way. Otherwise, market timing will not work at all. So many people criticize that emotions cannot be back tested, and actually many people will fail. Yes, many people will fail, but that does not mean you can say that market timing itself will not work. People will fail, but the process is not wrong. The process itself is, there's nothing wrong with timing the market. It will work. Of course, many people will not have the emotions and the discipline, will not have control over their emotions and the discipline to pull it off, but that's their problem. I mean, we should not provide wrong advice and say it is not possible to time the market because we have a conflict of interest. We will lose commissions. The truth is, market can be timed, but it is difficult to time it. Just like Everest can be climbed, but it is difficult to climb it. Not everybody can climb it. So that's a choice that you will have to make. So should I time the market? My advice is, if you are, look, you can certainly try. You should have a process. You should understand the pros and cons of it. You should backtest it and have a proper method and stick to it. And you can easily stick to, I mean, if you're young, if you're just starting out, then it's very easy for you to time the market. But be aware that timing the market requires discipline. SIP requires no discipline. So this is something that many people ignore. They think SIP will make you disciplined. SIP will make you do nothing. It doesn't average risk, it doesn't reduce risk, it does nothing. All it does is give you commissions for the distributors. Excuse me for the phone. So you should really take some time, study the methods that I have analyzed, or look at it elsewhere and find out whether such an activity of buying and selling equity is suited to you mentally. I mean, if you are in the, are you able to pull it off as a person? If you can, then I think you should try. Give it a try. What's wrong? After all, if you're young, it's easier to try and time the market when your portfolio is small. Of course, do it for reducing risk. Do not assume that. Do not say it's common sense returns will be higher. No, common sense and back testing never go hand in hand. Common sense will be east, back testing will say west. So keep all of that in mind, and then go ahead. We will continue this market timing series in future. So I'll catch you again in another video. Bye bye.